So you have just made profits from your investment. Great news, right? Well, not so fast. HMRC might want a slice of it. With the capital gains tax in UK dropping to its lowest allowance in years, more people than ever will get caught in 2025. But don't panic. In this video, we'll talk about what capital gains tax is, how much exactly you have to pay, and how you can use clever strategies to reduce or even completely avoid capital gains tax. Welcome to WiseInvestorPath, your trusted guide for investing in UK. So what is capital gains tax, or CGT as it is commonly known? It is the tax that you pay on the profit when you sell something that has risen up in value. It can be a share, property, or even an artwork. The important point to note is that you only pay on the gain and not the full sale price. So consider an example wherein you have bought shares of worth 7,000 and then you sell it at 12,000. So the gain over here is 5,000 and that is what HMRC looks at. You might be surprised to know that last year around 323,000 people paid capital gains tax. And with this new law coming into picture, that number is only expected to rise further. The CGT allowance in UK is a serious matter to consider, as it is the amount of gain that you can earn as tax-free every year. And now with the new law, it has dropped to just 3,000. Yes, only 3 grand. And for couples, you can save up to 6,000 between you and your wife. It used to be 12,300 not long ago. So if you have been investing over the years, you will really feel the pinch now. It's like imagine building your savings over years and in the end you have to hand over a big chunk of it to HMRC. It stinks, right? Having understood what CGT is, we'll now come to the point how much tax you have to pay. It depends on your income as it decides whether you are a basic rate taxpayer or a higher slab taxpayer and the type of asset. So if you are invested in shares and investment, then you have to pay 10% if you are a basic slab rate taxpayer and 20% if you are a higher slab rate taxpayer. Whereas if the gain is from selling a property which is not your main home, then you have to pay 18% for basic slab rate and 24% for a higher slab rate. So if you have been flipping houses for fun, now the HMRC will flip your wallet upside down. Let's break it further with two examples. Consider the example of shares. You have bought shares of 10,000 and sold it for 16,000. That's a 6,000 gain. Knock off your 3,000 allowance, you have got 3,000 left taxable. So if you are a higher rate taxpayer, that is 600 to HMRC. Consider the example of a property. You bought a second home for 200 grand and sold it for 260 grand. That is a 60 grand gain. After the allowance of 3,000, 57 grand is taxable. At 24% rate, it is 13,680 pounds. Ouch! That's a holiday or a new car or a year worth of bills gone straight to tax. But here's the good part. There are ways by which you can legally reduce your CGT bill. The first method is bet and ask. So you have an investment whose value has increased. So you sell that investment. You take that capital gain. You also take the principal that you had invested. This entire chunk you invest into ISA. So now once your money is inside ISA scheme, any future growth will be 100% tax free as ISA scheme provides 0% capital gains tax. The second method is you can gift your shares to your spouse. Say you have an investment of 6,000 and now that has increased to 12,000. So you have a capital gain of 6,000. With the new limit, there's a limit of 3,000 per person. But if you share your shares to your spouse, this sharing is tax free and she herself can also claim a rebate of 3,000. So with that, you will be saving entire 6,000 at 0% tax. The third method is use your losses. Always remember that if you sold an asset at loss, you can use this loss to compensate against the capital gains that you had, thereby increasing the amount of capital gains that you can take tax-free in any year. The fourth method is in pension. You can save your money in tax-free wrappers, wherein there is no capital gains tax at all. The fifth method is staggered sales, wherein you can sell your investment in staggered over the years. Say, as I told you, every year you have an allowance of 3,000. So you sell your 3,000 gains in first year. In the next year, you can sell another 3,000 of gain. So if you continue as such, every year you will be using 100% of your CGT allowance and also paying 0% on your capital gains tax. Think of it like playing chess with HMRC. You have to obey the rules and play smartly. And that is exactly why we created WiseInvestorPath. To make sure that everyday UK investors knows the moves that professionals use. So hit the subscribe button if you want your money to keep growing and less of it disappearing in tax. So the key takeaway is that with CGT allowance dropping to 3,000, more investors than ever are going to get hit by capital gains tax in UK. But with smart planning using ISA, spousal transfer and pension scheme, you can keep your money where it belongs, your pocket. If you found this useful, hit that like button and check out our full detailed guide on WiseInvestorPath.com for further information. By the way, if you want more simple and clear guides for investing in UK, this is exactly what we do. So don't just watch and forget. Hit that subscribe button and never miss a strategy that can help you save thousands. So let's grow your money with confidence, clarity and strategy.